Good morning, everyone. Welcome to this global update for stocks for the 20th of March. And we've just had another week where the price action pretty much defied what the fundamentals or the logical fundamentals would suggest. Markets are very good at forecasting forward or looking forward. That doesn't mean they get it right. Quite often, those perceptions are not correct. And sometimes we're also seeing shorter term factors such as short covering and speculative activity, which really has very little to do with the fundamentals. And so markets globally, not only stocks, but currencies and also the bond market continue to basically operate on technical grounds and not to any large extent on fundamental grounds. It's just the way it is these days, I'm afraid. For people that are fundamental purists, it must be extremely frustrating. But as I've been saying for weeks now, you've really just got to trade this market either as a trader or an investor. You've got to trade it fairly actively, and you've just got to rely heavily on the technical side of things. So the title for this weekend video is the Fed shrinks back, pulls back. They had projected once they raised interest rates in December for the first time in a decade that there would be 4 more rate increases this year. They held steady with the rate increase in March, which was pretty much what everyone expected. I think everyone would have been amazed if they'd done anything different to that. But they reduced their expectations now from 4 rate rises in 2016 down to 2, and I suspect that even 2 rate rises might be looking a little bit shaky as well. So, that was the outcome that we got. Markets liked it. They propelled forward again. But I'll just, as I have been for the last few weeks, I just want to start with a bit of a global perspective because we need to put all of these shorter term moves in perspective. So the Fed decision, they held rates steady. They lowered expectations. The impact was that it lowered the US dollar, which is certainly something that the Fed would have liked. And there certainly are some suggestions around that maybe there's been a whole coordinated global central bank move to get the US dollar lower, because that would help kick up inflation a little bit, which is what central banks want to do. It would certainly help out the emerging economies because they were heading for trouble. So there were certainly some benefits for some very interested parties in a lower US dollar. It also fired up stocks, so we saw another significant advance in the US stock market, and it also fired up commodities as well. So just a continuation of what we've seen for the last 4 or 5 weeks. So the question is the current short-term trends sustainable? With respect to crude oil, I really doubt it. I think what's happening in crude oil is that we've had certainly some short covering, started the rebound, and then just in the last week or so with the US dollar falling very sharply, we had a bit of a currency effect as well, and some speculation going with that. But gee, when you look at those supply and demand fundamentals, it's almost impossible to see crude oil going up any further from here. It may do, of course, on purely technical speculative grounds, but it's really hard to see it being sustainable. The US dollar has weakened off considerably. Is that going to be sustainable? Look, again, it's almost impossible to see, given the fact that the US is on a rate rising cycle, albeit perhaps a very, very slow one, but at least that's the direction they're heading. Whereas you've got Europe going further negative, you've got Japan opting to not go further negative, but still going with a continuation of massive stimulus. You've got China on a stimulus path as well. It's hard to see when the rest of the world is going to an easing bias and the US is going to a tightening bias, that the US dollar could continue to go down. That just completely defies logic. With respect to stocks, will they go up or down? At the moment, look, I can't call it, to be honest. There's certainly there's some negatives, and I've been pointing those out over the last month or so. But there's also some positives, and one of the positives that came through, which was a little bit unexpected, certainly for the market, was when FedEx reported through the week. And not only did they beat expectations, now FedEx is obviously a global um, transport company. They're a very clear reflection of the amount of economic activity, people moving freight and parcels around the place. Um, and they beat on the top line and the bottom line. So they beat on revenue and they also beat on profit. But more than that, they forecast a 21% increase in 2016 earnings per share, which is big. And that was way beyond what the market expected. So that result is, you've got to take notice of that. FedEx is a huge global company. And for them to be doing as well as they are, then you've got to acknowledge that some things are going okay. There's a lot of negatives out there, and I really do worry about the bond market, particularly related to energy and also to general corporate debt. So I think there's a much bigger issue there, but it may take a little while to play out. So therefore, in the shorter term, when it comes to stocks, look, I think the market's a bit overbought. We'll probably get a bit of a pullback, but I don't have a strong opinion either way at the moment. The other main perspective is, as I said at the start, this remains heavily a technical traders market. Don't try and base your decisions around fundamentals. You need to at least be taking into account technical considerations as well. So turning to the American market, the S&P rose by 28 points on the week, so it's been a very good couple of weeks, and we've had an extremely powerful rise from the lows of the 11th of February, as we'll see in a moment. The index rose above the 200-day moving average, which of course was always going to bring in some technical buying, just because that's what happens. But it's now reached another level of resistance. So and it is overbought, so it'll be very interesting to see what happens around this level. All the technical indicators are much stronger. The breadth indicators are much stronger. The advanced decline lines are much stronger. But there's still an element of defensiveness about the sectors that are really doing well. Healthcare is still lagging badly. Financials, yes, they went up, but relatively speaking, they went up more slowly than other sectors. So the financial sector is not leading, and that's not healthy. And we've still got the defensive sectors of consumer staples and utilities are still clearly the leaders. So there's still a bit of a defensive bias, and also the volumes aren't really that flash. So yes, a lot of stocks have rebounded, but I've just got to wonder how much of it has been short covering and just a normal rebound from heavily oversold. The other thing about the American stock market is the correlation with the price of oil continues to influence stocks. It's almost a 100% correlation. The two of them are moving absolutely in lockstep with each other, with virtually no time lag at all. If one changes direction, then the other one goes with it. A retracement is now likely in the American market. I believe it's a bit overbought, so let's take a look at the chart. So we'll start first of all with the big picture monthly chart, and you can see the weakness that we had in January. We got a bounce. We went down again in February, and then we bounced, as you can see, and that all bounced off this October 2014 lows. So technically, we've now had a triple test. If we come down again, and I'm not saying we will, but if the index comes down again, then I think it's almost certain that this level around the 1820 mark will give way, and we'll get a bigger retracement, probably down to this 1578 level, which would be a 38.2% retracement of the whole run from when we started in March of 2009. So that would be technically spot on, and it would also bring us back exactly to the 2008 peaks and almost exactly to the 2000 peaks. So that's a big picture look because that's a monthly chart. So that could take some time to play out, but technically that would be, that would be pretty much in order with what we're seeing at the moment. Turning now to the daily chart. You can see the red line is the 200-day moving average. We closed above that and then surged on, as you would expect, as it brought the technical traders in. But you can see that the RSI is now overbought. It's been an enormous run from 1810 up to 2050 in really about 5 weeks. So it's been an enormous run, well overbought. So, and you can also see we've got a declining trend line here, which picks up the highs from November and December of last year. So we're tucked right up underneath that. Now, if we were to get a retracement of this level, which would be normal, we've got a couple of levels. One is the peaks, the little peaks that we formed on the 13th of January and the 1st of February. They come in at basically 1950. And then we've also got a fib retracement on this little run here, and that comes in at about 1957. So that would be the area that I would be looking for as the most logical support area in a bit of a pullback. But I think the odds now have shifted in the absence of something blowing up with China or whatever it might be with the bond market. I think the odds now have shifted substantially to the fact that for the rest of this year, we're going to get a big sideways pattern of volatile movement. I think that has now become pretty much the base case. So moving on then to the Aussie dollar. The Aussie dollar finished at 76, a real surge last week, and that was heavily related to the Fed decision. And also to the ECB decision as well, because they've gone further into negative interest rates. Whilst it wasn't a big move, it just makes our currency look that little bit more attractive to overseas investors. So we managed to break out of the trading range. The top of the trading range on the Australian dollar was 74. We finished up at 76 and got higher than that during the week. But I must say, as I pointed out last week, the underlying fundamentals around commodity prices just don't support the commodity prices being where they are, and therefore do not support the Australian dollar being where it is either. I think a lot of it was about short covering on the Aussie dollar. We were heavily short sold, so there's been short covering there in the foreign exchange market, and then of course that's also drawn in quite a bit of speculation as well. But interesting to see the Australian dollar. There was certainly some profit taking on Friday night in the Australian dollar. And as I pointed out at the start, a weaker US dollar is really a complete anomaly because the policy of the Fed is completely divergent with the policy of just about everybody else around the world. Everybody else is on an easing bias. The Fed is on a tightening bias. So for a weak US dollar, that just makes no sense at all. And I don't believe it'll continue. I think it will reverse itself. But probably not to a great extent. I think we've seen a lot of the gains in the US dollar. So US dollar should firm. That should pull the Australian dollar down. I believe commodities should weaken. That should pull the Australian dollar down as well. And I have to observe that the RBA must be absolutely hating this. They're on record as saying they want the dollar somewhere down around the 65 cent mark. And I think if the Australian dollar stayed where it is in the mid to high 70s, there would be a significant risk of a recession in Australia if it stayed there long enough. So I think if all the drivers should point to the Australian dollar being significantly lower, certainly below 70 cents, and all the vested interests, such as industry, the RBA, the government, everybody wants the dollar to be below 70 cents. So it'd be very interesting to see how that plays out. Turning now to Aussie stocks, the ASX 200 gained just 17 points for the week, so just continues to underperform the US market by a big space. It's just poked its head above the downtrending channel that we've been looking at now for several months, but look, it's pretty unconvincing when you have a look at it. We had a bit of strength in miners and in banks, but it's not something that lasts any more than a few days. And we're just going to continue to be pushed around by overseas hedge funds. And we're such a small part of the global scene that, if they decide that they want to just reallocate some capital somewhere else, which could be a decision that's got nothing to do with our market whatsoever. It's just a global asset allocation decision. And because the amount of money that they're moving is so significantly large, they do represent something like 40% of our market, then, you're going to see those sort of big swings that we've seen in asset prices. So let's take a look at first of all, at the Australian dollar. So you can see we certainly had a range through here, which was peaked out at about 74. The bottom of the range was around 69. So that's been the range now since the middle of last year. Poked up above it, and that's really thanks to central bank policy. No other reason, certainly not fundamentally driven, that's for sure. So we'll just have to see how it plays out. Turning now to the ASX 200. So you can see there's this downtrending channel that we've been looking at here, which started around about April of last year. You can see the red line, which is a 150-day moving average, clearly still in downtrend. The index has managed to scramble back above it just a little bit, and also just having a little peep over the top of this channel. But you've got to look at the size of the daily ranges. These candles, they're really quite small, and nothing is really closing very definitely. See the last 4 or 5 green candles. They're all closing well off their highs. There's no real conviction in the buying. We had one solid down day, which was last Tuesday. That closed on its lows, but then immediately turned around and went back up again. There's just, other than these 3 or 4 days here at the start of March, there's absolutely no conviction in the rise in the Australian index. It looks nothing like the American index. Let me just go back and recap what the American index looks like. It's just chalk and cheese between those two indices in terms of the power behind the move. It's quite stark. While I'm here, let's have a look at the US dollar gold price. This is a weekly chart, so we're back above the 150-week moving average, which is a very long-term moving average. I certainly think that there's enough evidence now that the gold market is moving back into a bullish phase. Let's look on the daily, and you can see that we have been overbought now for some time. We've certainly got some divergence here. You can see that the price has been moving higher, and the RSI has been moving lower, which is indicating that, yes, the prices are still rising, but they're rising at a slower and slower rate. So I've been looking for a correction of this first move. So if you want to take a bigger picture look at what's happening here, I'll do it on the weekly chart. So I think what we've had here, here's our first leg to the upside. So that's the first wave after a 4-year bear market, which was incredibly severe. There's the first leg higher. The next thing that we would expect is to get some sort of correction of that move higher. So that would be the second phase, to get a partial correction of this move. And then we are likely to embark on, if this is going to be a bull market, on the main part. which could then run it to wherever it's going to run it to. So that's the bigger picture. So I'll zero in now on this little bit here. So this secondary correction or consolidation of this first move. So that's this part here. Now, so far, most of the time, these little corrections will occur in what's termed an ABC kind of pattern. So here's our A leg, here's our B leg, and under many circumstances, we then get a C leg that takes us down to a lower low, and we've got an obvious area here, which is around the 11.95 mark, which is a 38.2% retracement of this run higher, and it's also corresponds to the peak of the 15th of October. So if the market were to do an ABC correction to around 11.95, that would be technically perfect. That would get rid of the oversold conditions, and it would really set the market up for the main run higher, which could be expected to run for probably several years. However, if there is, so let me just say that I think that's still on the table. However, if the market is stronger than would allow a normal ABC type correction selling, then we may have already seen the low. So here's our first leg down, here's our rebound, partial rebound, and then we may go into some sort of, sideways complex up and down, but not actually form a lower low below 1230. I think that's a possibility, and the gold market is one that's very volatile, and I'm getting a bit surprised and encouraged by the fact that it's held up so well. There's been plenty of days when the US market has gone up, the stocks have gone up, and gold is a bit of a fear trade, and gold stocks have not fallen, even though the general stock market has gone up. So there are lots and lots of signs of strength in this. So it's possible that we don't get a pullback to 11.95. It's possible that we just get a consolidation for several weeks, possibly even a couple of months, and then we move higher. So, but either way, whether it's a retracement or more of a sideways consolidation, we've got a pause going on, and now's not really the time to be building into gold stocks. The short-term risk and reward is not that attractive, but there's certainly some considerable upside, that's for sure. Let's look at other commodities. So gold was higher by $4 on the week. Not a great deal of change there. It's up by $18 year to date. Short term overbought, long term looks good. And as I said, we've got a bit of a retracement consolidation going on. Turning to other commodities, copper was steady at 229. It's really just trading with the US dollar. It edged up about 2 cents, I think, on the week. Crude oil went higher, went above 40, and then eased on Friday. The fundamentals still look very poor. It's really hard to see how this could keep pushing higher. Part of the rebound in crude oil was short covering initially. Then I believe the speculators joined in, drove it a bit further. That got it up to 36, 37, which was really the top of the range. And then the fall in the US dollar took it up to 40. So we've really had those three things. We've had short covering, we've had speculative activity, and then on top of it, we've had a weakening US dollar currency. And that's really what took it up to 40. But from a fundamental point of view, it doesn't look sustainable up here. There's the crude oil chart on a 1-year basis, and that's pretty much speaks for itself. We've now reached another level of resistance up there at 40. And we'll just take a bit of a bigger picture view. There's a 3-year view of crude oil. So that puts it even more in perspective. So the move we've seen in crude oil so far, not very much in the bigger scheme of things. There's the spot copper chart, strengthened just a little bit more. So overall, to wrap it up, and look, this is the same slide as I've shown the last 2 weeks. And I thought about writing something different, but I cannot find words that describe the approach that you should be taking any more appropriately than these words. So I'm just going to give you the same slide again. I'm sorry, but this is the most appropriate strategic approach in my opinion. You should be looking to work only from the extremes of price and sentiment. I can't state it any more clearly than that. You shouldn't stay in a position for too long because nothing is really trending that much. We're getting a lot of volatility, but not really that much of a trend. Don't rely on fundamentals or logic because they're not meaningless at the moment, but gee, they don't count for a lot. So I wouldn't do that. Definitely don't chase a trend because the further it runs, the more likely it is to reverse. And as we've seen this year, the moves are sudden. They really are sudden and they're very emphatic. So that wraps it up for this week. For anyone who's not a member, there's my contact details. I think there's some terrific opportunity in the market. It's not going to be easy to get your hands around those opportunities because the market is so volatile and you really need to move at times when your logical brain is telling you that it's not the time to move. This is a market to be a real contrarian, but in a very disciplined way. And most people find that incredibly difficult to do. So if you're struggling with that, if you want to avail yourself of the opportunities, which I think are tremendous, then you might like to get in touch with me and we can talk through some of the possibilities. That's it for this week. Cheers.